Let's jump right into today's analysis. We're looking at some seriously dense financial data today, and we're going to decode it to find the clear, actionable takeaways. We're taking a real top-down approach this time. So we'll start with the broad economic forces shaking up the global markets right now, and then zoom all the way down to the specific technical setups for some of the most heavily watched tech stocks out there.
Here's our roadmap. First, macro risks and the Fed outlook. Second, the CTA liquidity threat. Third, sector focus on the semiconductor rebound. Fourth, Tesla and AMD trading zones. And finally, number 5, Corning and ServiceNow updates.
All right, Section 1, Macro Risks and the Fed Outlook. So you've probably noticed there's a lot of market anxiety right now, right? It's mostly being driven by the tech-heavy NASDAQ taking a hit. But here's what's incredibly interesting. If you look under the hood, the S&P 500 internals are surprisingly positive. The source document noted that on the day of the snapshot, 357 stocks were actually up, with only 145 down. So what's really driving the panic at the top? Well, look at this timeline of immediate risk catalysts. We've got the Fed interest rate decision, Jerome Powell's press conference, which everyone is waiting for, and major tech earnings from heavyweights like Meta and Microsoft, all colliding at the exact same time.
The tension here is palpable. Right now, the general Wall Street consensus is that rates are just going to sit flat, unchanged. But Citadel Securities, a massive institutional player, is completely bucking that trend. They're an absolute outlier, predicting a surprise 25 basis point hike.
And the source makes a really stark point about this. It warns that if this unexpected hike actually happens, the market is going to be caught completely off guard and essentially thrown into chaos. Think about it. The Federal Reserve is actively trying to rebuild its credibility on inflation. So dropping a sudden, untelegraphed rate hike on the market, that would immediately shock the system and disrupt broader market stability.
Moving on to Section 2, the CTA liquidity threat.
The analysis here poses a really critical question. What exactly happens if the broader market loses its footing and the S&P 500 dips below that highly critical 7,200 technical support level?
Well, the answer is a staggering $70 billion. A break below that 7,200 mark could trigger $70 billion in immediate mechanical dumping by commodity trading advisors, or CTAs, and that's just in the U.S. market alone.
But wait, it actually gets worse. The source calculates that this initial sell-off could cascade into a $187 billion wave globally. That is a massive systemic event. And the crazy part? It would be driven entirely by automated risk management and forced liquidations, having absolutely nothing to do with fundamental business valuations.
Okay, Section 3. Sector focus on the semiconductor rebound.
Now, despite the recent, pretty violent sell-off in the semiconductor index, the SOXX, the source analysis uncovers a really surprising contrarian setup. They lay out 4 specific reasons why you shouldn't bet against semis right at this level. First, price action has bounced perfectly off the 100-day moving average. Second, disciplined short sellers are naturally covering their positions and taking profits here, which creates buying pressure. Third, the relative strength index is dropping below 20, which is a rare, deeply oversold level. And fourth, honestly, the fundamental risk-to-reward ratio is just terrible for new short sellers right now.
Let's actually break down that math. Mathematically speaking, if you short the index here, your downside target is only about 6 points of profit. But if it bounces from this support, the upside target is around 10 points, potentially running all the way back up to the 550 level. So the math heavily favors the risk of a sharp bounce, vastly outweighing that super limited downward profit potential.
I really love how the source document distills the market psychology here. It says, when 100 buyers chase one asset, prices soar. When one buyer faces 100 assets, prices collapse. It's such a brilliant way to illustrate how sheer capital flow, leverage, and downright panic, not just fundamental earnings, are what actually drive these violent, irrational-looking tops and bottoms in the tech sector.
Let's head into Section 4, Tesla and AMD trading zones.
Shifting gears down to the micro level, let's look at Tesla. It's broken its previous supports and set up some highly defined new technical battlegrounds. The new short-term swing trading zone is now sitting between $235 and $270. Meanwhile, previous support has completely flipped into heavy resistance, up between $315 and $368. And hey, if you're looking for an aggressive, long-term entry based on future estimates, that deep support zone is way down between $175 and $209.
Moving over to AMD, its critical zones have violently shifted too. That massive drop from $580 to $454 has completely rewritten the short-term playbook. Current support is holding steady between $432 and $453. Overhead resistance is pretty heavy between 506 and 528. And if the entire sector ends up flushing, you're looking at deep support down between $344 and $366.
But here's the crucial thing to remember. While these technical levels are clearly drawn out on the chart, the upcoming August 4th earnings report is going to be the ultimate test of those boundaries. A massive beat or a huge miss will instantly rewrite these zones all over again.
And that brings us to Section 5, Corning and ServiceNow updates.
First up is Corning. They posted a surprisingly strong earnings beat, and it was driven heavily by their optical communications segment. Revenue hit $2.07 billion. That is up 32% year over year. The forward PE has cooled down to around 30x, which the source document considers to be fundamentally reasonable. From a technical standpoint, the current resistance zone to keep an eye on is $124 to $137, with a very attractive deep support zone at $83 to $95 if we see a pullback.
Next, let's look at ServiceNow. To really get this one, we need to define a key technical concept used in the analysis: small volume upward momentum. Basically, this describes dense, sustained buying pressure, but without those massive obvious volume spikes. It's a classic signal of stealthy, quiet institutional accumulation. And that is exactly what the source is observing in ServiceNow's price action right now. Because of that stealthy momentum, $120 is the absolute line in the sand. ServiceNow needs a clean, decisive breakout above 120 on a closing basis. If it gets that, this momentum could easily convert into a massive technical run targeting the $143 to $157 resistance zone.
So, pulling this all together, it's important to remember that none of these technical levels live in a vacuum. The upcoming massive capital expenditure data from mega-cap tech companies, that's going to be the ultimate decider. If the tech giants report that they're still pouring billions into infrastructure, that fully validates the semiconductor rebound. But if they pull back, it could absolutely crush this entire setup. Which leaves us with a pretty pivotal question to think about. With capital flows violently shifting, major tech spending numbers looming, and the Fed about to make its move, is what we're seeing right now a genuine technical bottom? Or is this just a brief, quiet pause before a much deeper, algorithmic, CTA-driven correction takes over? It is a fascinating and precarious setup for sure, and the data over the next few days will give us our answer. Thanks for tuning into this analysis, and I really hope this helps you navigate all the volatility ahead.